Index funds. They're simple. They're smart. And yes, they work. But before you throw your money into the market, you need to understand what you're buying. An index fund is a basket of stocks. Not just any stocks, stocks from a specific index, like the S&P 500. That means when you buy the fund, you're buying a tiny slice of every company in that index. Apple, Microsoft, Google, all in one move. So when the index goes up 1%, your index fund also goes up 1%. When it drops, you drop too. That's the deal. Now let's talk pros. Number 1, passive investing. No stock picking, no market timing, no stress. Just set it, forget it, and let the market work. Number 2, diversification. One fund, hundreds, sometimes thousands of companies. That means less risk, less drama, and fewer surprises. Number 3, performance. Study after study shows that most active investors fail to beat the market long term. Index funds? They are the market. And over time, the market tends to win. But there are trade-offs. You won't beat the market. You'll just match it. You can't control the holdings. Good stocks, bad stocks, you get them all. And you'll pay a tiny fee to track the index. That's called a tracking error. Small, but worth noting. Now, if you're wondering about ETFs, they work just like index funds. Same diversification, same structure, but they trade like stocks. You can buy and sell them throughout the day. They're often more tax efficient, especially in a taxable account. But if you're using a retirement account, the difference is minimal. Bottom line, if you want to invest without constantly researching the market, if you want to spread your risk without juggling dozens of stocks, and if you care more about steady growth than beating the system, index funds or ETFs might be exactly what you need. Just remember, low fees, strong diversification, and a long-term mindset. That's how index investing wins. Now click the link in the description to see which index funds match your goals and take the first step to smarter investing.